Most people think of global trade as something abstract, distant, almost academic. Container ships, trade agreements, headlines about tariffs that come and go. But the reality is that global trade quietly shapes the most personal parts of your financial life: your salary growth, your job stability, the price you pay for housing, food, energy, and even time. You don't feel global trade when it's working. You only notice it when it starts to break, and by then, the consequences are already embedded into your long-term trajectory. For the last 30 years, the global economy has operated on an assumption so deeply baked in that most professionals never question it. Goods move freely, capital flows efficiently, supply chains optimize relentlessly. Companies reduce costs year after year, margins expand, prices fall or stagnate, and productivity gains feel almost automatic. Inflation stays low, central banks look competent. Real incomes grow slowly but steadily. The system feels stable, not because it's simple, but because its complexity has been hidden behind reliability. This created a psychological baseline for an entire generation of professionals. You expect that if you upgrade your skills, stay employed, save consistently, and invest patiently, the system will do the rest. That your labor can be converted into freedom over time through compounding. That markets may fluctuate, but the underlying structure remains intact. That efficiency is permanent. What's changing now is not a single policy or a single crisis. It's the quiet reversal of that assumption. Global trade is fragmenting, not collapsing overnight. Fragmenting slowly, structurally, and unevenly. And the risk isn't just slower growth. The risk is that the invisible scaffolding supporting long-term financial planning, predictable inflation, stable margins, reliable employment ladders, and efficient capital deployment starts to weaken. Trade fragmentation doesn't announce itself with a siren. It shows up as small frictions that compound over time. A component that used to cost $10 now costs $12. Shipping that took 2 weeks now takes 6. A supplier that was once interchangeable becomes politically sensitive. A country that was once neutral becomes strategic. None of these changes feel catastrophic in isolation. But systems don't fail from single shocks. They fail from accumulated inefficiencies that quietly erode margins, trust, and optionality. Think about how businesses actually work. Profit margin is not a philosophical concept. It's a narrow band between survival and failure. If a company operates on a 10% operating margin and costs rise by 3% without equivalent pricing power, nearly a third of its margin disappears. That company doesn't announce a crisis. It freezes hiring, delays raises, cuts long-term projects, increases prices where it can, and slowly the growth engine that once supported wage increases and innovation starts to stall. Now zoom out. Apply that same math to an entire economy. For decades, global trade allowed countries to specialize aggressively. Labor went where it was cheapest. Manufacturing clustered where scale made sense. Capital chased the highest risk-adjusted returns across borders. This wasn't ideological, it was arithmetic. A company that could reduce production costs by 20% by sourcing globally didn't do it to make a political statement. It did it to survive competition. And as millions of companies made the same rational decision, the global system optimized itself around efficiency. The result was a long-term deflationary force. Even as money supply expanded, global labor arbitrage and supply chain optimization suppressed prices. This allowed central banks to stimulate aggressively without triggering runaway inflation. It allowed governments to accumulate debt at low interest rates. It allowed households to feel wealthier as asset prices rose faster than wages. And it allowed professionals to build financial plans, assuming that inflation would remain manageable and growth would remain predictable. Trade fragmentation reverses that logic. When countries start prioritizing resilience over efficiency, costs rise by design. Redundant supply chains are more expensive than optimized ones. Domestic production costs more than global sourcing. Strategic stockpiles tie up capital instead of deploying it. These are rational choices in a world where trust is declining, but they are economically inflationary choices. This matters because inflation is not just higher prices. Inflation is a tax on predictability. It shortens time horizons. It distorts investment decisions. It punishes savers and rewards leverage until leverage breaks. A professional earning $120,000 a year with expenses of $80,000 might feel financially responsible. But if inflation quietly averages 4% instead of 2% for a decade, their real purchasing power erodes far faster than most spreadsheets assume. The difference between 2 and 4% inflation over 20 years isn't marginal. It's transformative. One doubles prices roughly every 35 years. The other does it in 18. That gap changes behavior. It forces households to take more risk just to stand still. It pushes investors toward assets that feel protective rather than productive. It rewards short-term pricing power over long-term innovation. And it slowly converts a growth-oriented system into a defensive one. Trade fragmentation also introduces something more subtle: political risk embedded into everyday economic activity. When supply chains cross fewer borders, and those borders are chosen based on alliances rather than efficiency, economic decisions become entangled with geopolitics. A factory isn't just a factory, it's a strategic asset. A shipping route isn't just logistics, it's leverage. This changes how capital is deployed. Capital prefers optionality. It flows most freely when exit paths are clear and rules are stable. Fragmented trade reduces optionality, it narrows corridors. It increases the risk that a profitable investment becomes stranded due to policy changes rather than market failure. Over time, this raises the risk premium demanded by investors. Higher risk premiums mean higher costs of capital. Higher costs of capital mean fewer long-term projects clear the hurdle rate. Again, none of this happens dramatically. It happens quietly through missed opportunities. Projects that would have been built 10 years ago no longer pencil out. Innovation slows not because people are less capable, but because the financial environment punishes long-duration bets. The economy becomes more transactional, less visionary. For individuals, this manifests as a feeling that effort no longer converts cleanly into progress, that you can do everything right and still feel stuck, that your savings rate improves, but your sense of security doesn't, that your income rises, but your optionality doesn't expand proportionally. This isn't a personal failure, it's a systemic shift. The long-term risk of trade fragmentation is not collapse, it's stagnation with volatility. A world where growth exists, but it's uneven, politicized, and fragile, where some sectors benefit from protection while others quietly decline, where inflation is manageable but persistent, where crises are smaller but more frequent, and where long-term planning becomes harder because the system no longer rewards patience as consistently as it once did. This is the environment your financial identity must adapt to, not by panicking, not by chasing trends, but by understanding that the assumptions baked into traditional financial advice were formed in a very specific global context, one that is slowly changing. Another way to understand trade fragmentation is to look at it through the lens of redundancy versus efficiency. In finance, redundancy feels wasteful in the short term. Holding excess cash reduces returns. Diversifying beyond necessity dilutes upside. Maintaining backup suppliers raises costs. But redundancy is what keeps systems alive under stress. And when redundancy replaces efficiency at scale, growth slows by design. For decades, the global economy stripped out redundancy aggressively. Inventory was minimized. Supply chains were stretched across continents. Production schedules were tightened until any delay became costly. This worked because the probability of disruption was low enough to justify the risk. The system traded resilience for returns, and for a long time, that trade paid off. Now that calculation is being reversed. Companies are being asked, sometimes required, to hold more inventory, source domestically, or maintain parallel suppliers. Each of these decisions raises the capital tied up in operations. Capital that once flowed into expansion, research, or wage growth now sits idle as insurance. From a risk perspective, that makes sense. From a growth perspective, it's a drag. If a company once turned over its inventory 6 times a year and now turns it over 4 times, that's not a headline, but it's a 33% reduction in capital efficiency. Multiply that across thousands of firms and you get an economy that looks busy but produces less surplus. Surplus is what funds everything people care about but rarely connect to trade. Higher wages, better public services, technological progress, more leisure time. When surplus shrinks, competition over what remains intensifies. And competition over shrinking surplus is where political and social tension accelerates. This is why trade fragmentation isn't just an economic story. It's a distribution story. Slower growth forces harder choices about who gets what. And when growth slows quietly, those choices feel arbitrary and unfair, even when they're structurally inevitable. Trade fragmentation also changes the nature of risk itself. In an integrated system, risk was often market-driven and cyclical. Recessions happened, but recoveries followed familiar patterns. In a fragmented system, risk becomes more structural and persistent. Instead of sharp downturns followed by rebounds, you get rolling disruptions that never fully resolve. This is harder to adapt to psychologically. Humans are good at responding to acute threats. We struggle with chronic instability. When uncertainty becomes the background condition rather than the exception, decision fatigue sets in. People become more conservative not because they want less, but because they trust the future less. That shift matters for capital formation. When households delay large purchases, when businesses delay expansion, when investors demand quicker paybacks. Each of these decisions is rational individually. Collectively, they slow the system further. This is one of the least discussed consequences of trade fragmentation. Time horizons compress. Long-term thinking becomes harder to justify when policy, costs, and access can change unexpectedly. The discount rate people apply to the future rises, not because interest rates are higher, but because confidence is lower. When discount rates rise psychologically, compounding loses its emotional pull. Saving feels less rewarding. Investing feels more fragile. Planning feels speculative, and that undermines the behaviors that once supported long-term financial stability. Another underappreciated effect is how trade fragmentation reshapes innovation. Innovation thrives in environments where scale is accessible, where a successful product can reach global markets quickly, where fixed costs can be amortized across large demand pools. Fragmented trade shrinks addressable markets. It regionalizes opportunity. This doesn't stop innovation, but it changes its character. Innovation becomes more incremental, more localized, and more defensive. Instead of breakthrough productivity gains, you get workarounds. Instead of systems-level improvements, you get patches. Over time, this lowers the ceiling on growth without causing obvious failure. For professionals, this means fewer moments where a single skill or idea unlocks exponential upside. Progress becomes steadier but flatter. Careers extend longer but peak earlier. Security improves marginally while upside narrows significantly. This is why many high-earning professionals feel financially constrained despite strong incomes. The issue isn't income, it's leverage. Not financial leverage, but systemic leverage. The ability to plug effort into a system that multiplies it. Trade fragmentation reduces that multiplier. When the multiplier shrinks, the difference between gross income and retained freedom becomes more pronounced. Taxes feel heavier. Costs feel stickier. Savings feel less powerful. This feeds a quiet sense of frustration that no amount of budgeting advice resolves. Trade fragmentation also complicates the traditional advice around diversification. In theory, diversification reduces risk by spreading exposure across independent assets. In practice, fragmentation introduces shared constraints. Supply shocks, policy changes, and geopolitical decisions affect multiple sectors simultaneously. This raises correlations precisely when you want them to fall. During stress, assets that once behaved independently start moving together, not because of fundamentals, but because the same constraints bind them. This doesn't eliminate diversification, but it weakens its protective effect. Over long horizons, this increases volatility around the path of compounding, even if average returns remain acceptable. And volatility around the path matters more than people realize. It increases the probability of bad timing, of forced decisions, of abandoning strategies prematurely. This is why many people feel like they're running faster but getting nowhere. The treadmill hasn't sped up, the incline has increased. None of this means that growth disappears. It means growth becomes more contested, more uneven, more dependent on positioning rather than participation. And that's uncomfortable for a generation raised on the idea that broad-based growth was the default. The long-term security risk is not military conflict alone. It's economic fragility that amplifies every shock. When supply chains are less flexible, disruptions last longer. When capital is less mobile, misallocations persist. When trust is lower, cooperation during crises weakens. These dynamics don't just affect GDP. They affect social cohesion, political stability, and individual financial psychology. A system under constant low-grade stress changes behavior. Households save more defensively or spend more impulsively. Businesses hoard cash or overinvest in protection. Governments prioritize control over efficiency. None of these choices are irrational in isolation. Together, they create a feedback loop that slows growth further. For someone trying to build long-term financial freedom, this environment demands a shift in mindset. Not toward pessimism, but toward realism. The old playbook assumed a rising tide that lifted most boats. The new environment resembles choppy water, where balance matters as much as speed. Understanding trade fragmentation isn't about predicting the next recession or geopolitical flashpoint. It's about recognizing that the background conditions shaping your financial life are changing, that margins matter more, that buffers matter more, that optionality is no longer a luxury, it's a form of insurance. In a fragmented world, the goal isn't to outguess the system. It's to avoid being overly dependent on its smooth functioning. To build resilience, not by withdrawing, but by acknowledging that efficiency has a cost, and that cost is fragility. The uncomfortable truth is that many financial plans implicitly assume a world that no longer exists, a world of ever cheaper goods, stable institutions, low inflation, and predictable growth. As that world fades, the gap between looking financially responsible and actually being financially resilient widens. Trade fragmentation doesn't end prosperity, but it does change who captures it, how reliably, and at what psychological cost. And the earlier you internalize that shift, the more intelligently you can adapt your own long-term trajectory, quietly, deliberately, and without chasing narratives that no longer fit the underlying math.